We will discuss the law of supply and demand in this video. A trader makes money by speculating on small changes in prices. By understanding why prices change, we can form a bias and anticipate the direction of the market. Price movements are based on supply and demand. The chart that is printed is the result of supply and demand. Therefore, it is critical to study the law of supply and demand before learning about technical and fundamental analysis. It is crucial for us to recognize whether demand or supply is higher in order to make the most profitable trades. To retain this key principle, watch this video several times and return to it from time to time. By understanding the keys that we will discuss in this video, you will be able to tell high quality trades from poor quality trades. Trust me, listen, this is one of the most important videos in this course. Please take some time to digest the fundamental principle of supply and demand, and I promise you, your trades will become higher quality, you'll make higher profits, and execute trades with higher risk to reward. This is very, very important. Let's get to it. Okay, now we're going to talk about the law of supply and demand. If you pay for this course, this is one of the most important videos in this course. This video alone, with the videos that come in this section on supply and demand zones, is worth the price of the course. If you understand this concept, this will help you become a marksman in the market. This will help you become a sharpshooter in the market. This will help you prevent overtrading. This will help you prevent taking trades that don't make sense. This concept helped take me to a new level. It helped me be more patient in the market because I understood actually how price moves. And there are certain times and certain circumstances where the market will not move. And I should not be trading at those times. I should know, I should be able to read and see the footprint of the suppliers, of the sellers, the big sellers and the big buyers. Once you understand how to see their footprint, you'll be a lot more patient and you will try to get into the trades and pay attention to those trades where the big buyers and the big sellers are. So we're going to talk about the law of supply and demand from a theoretical, philosophical perspective, but also I'm going to teach you exactly how the auctioning process happens that impacts the indices, right? And the market overall works generally like this, generally. So understanding this is very, very, very important. So let's talk about supply. What is supply? So many of us are familiar with supply and demand when it comes to our normal lives. When it comes to supply, an easy example is when COVID hit, there was a shortage of supply with toilet paper. So the toilet paper supply started to go down and diminish. The hand sanitizer supply started to go down and diminish. The supply in the market is just the total amount of what is available, okay, for purchase. So there was toilet paper supply, there was hand sanitizer supply. And what happens in the market is as demand rises, okay, so the demand is the willingness and the desire of buyers to purchase that supply. So the demand during COVID, or the announcing of COVID for toilet paper and hand sanitizer, was so high that the supply was being bought in big quantities, causing the supply to diminish. And as demand rises, what happens? Supply starts to diminish, and it gives the suppliers the ability to charge more. They can charge more for that thing, right? So there were jokes about toilet paper being sold for $100, right? I wouldn't be surprised because that's just the concept of supply and demand, right? But supply and demand in the market is defined as the total amount of shares, bonds, commodities, etc., offered to buyers at a given period and at a given price level. So it is usually determined by the market and how it's moving, what's going on in the economy, right? Going back to that example about higher demand, if there's a lot of demand in the market for stocks and other instruments, then that will start to cause suppliers to increase supply, to start to sell because there's a lot of demand. They can make a lot of money. People that have been holding on to certain positions for a few days or a few weeks, they can start to unload those positions because there are buyers there, right? So if the demand is low though, then a supplier may drop the price. So during COVID, restaurants started going out of business. During a recession, for example, the house market, the interest rates go up, so people can't borrow money. So the prices of houses go down because demand is lower, right? So it's the same. Now, supply, we're going to get into this a whole lot more. Watch this video several times if you need to, okay? So supply is represented by sellers in the market. And what is demand, as we talked about? So in regards to the market, demand is based on the willingness and desire of traders to buy offers at a given price. Traders or investors to buy offers at a given price, right? So that means that you can normally predict how much demand is in the market by looking at the buying behavior, looking at how strong the buying behavior is. And demand is also influenced by prices in the market. As price goes down and people are looking for bargains, then demand rises. So that's why people say buy the dip, right? Because normally when price goes down, people are trying to buy up the supply at a cheaper price. So during COVID, they were to put toilet paper on sale. The price was low. People would go and buy a bunch of it because the price is low. So that's the dynamic here. So it's the same in the market. So if supply increases, or if supply is low, if the market is cheap, then people will buy. As the prices go higher, as people are buying, the prices go higher, suppliers tend to start to sell. Why? Because there's buyers there to consume their offers. So demand is represented by buyers in the market. And here's just a quick fundamental rule to remember. If demand is greater than supply, then the price will rise. If supply is greater than demand, then price will fall. If demand is equal to supply, then price will remain the same. So remember this, because this principle will be seen in the market. So how do the markets move? How do they move? This is what we need to know. How does that bar go up? How does the line chart go up? How does that bar go down? The candles, how do they go down? So the market won't move until trades occur. When you're looking at the Asian session or one of these sessions when the market is barely moving, nothing is happening, that's because trades are not occurring. Demand and supply is equal. Trades aren't occurring. So I'm going to talk about the futures market, which is stocks, but if we trade indices, if we trade other things, it works similarly. Okay, the concept is similar. So I like to use this one because it's easy for us to see in the chart. It's an easy dynamic. The market works in a two-way auction process. There's a bid and there is an offer. So if you look at this column here, this column, the bid column represents buyers. So the buyers are saying, hey, at this price, I want to buy 36. I'm going to just say 36. That's how much I want to buy at this price, 20.50. Then we have another buyer, and there's a typo here, so just stick with me when it comes to this. This should be a higher amount. This should be actually 39.50. But at 39.48, a little bit lower than what should be 39.50, we have someone that's willing to buy 275. At a price point lower, 39.48, we have somebody that's willing to buy 522. That's the buyers. They're bidding. On the other side, you have sellers who are offering supply up. Someone's at 39.50. This should be 39.50. Someone at 39.50, 25, with a size of 158. Someone's at 39.50.50 with the size of 324. Okay. So on both sides of the market at different price points, you have buyers who are waiting for the price to come here. Once the price comes here, that order will be triggered. We have sellers waiting for the price to come up to this particular price point. Once price rises to that price point, buyers come in and take these orders, this size, then that order will be triggered. So price is somewhere in the middle, then nothing happens. Okay. So if price is somewhere, so here's 20, or this should be 39.50 and 39.50.25. Price is at 39.50.10 in the middle, then nothing's happening. Nothing's happening. So it's an auction process. For an order to be executed, it must be paired with another order with the opposite intent. Okay. So to execute a sell, it must be paired with a buy. The market moves because of this process. So understanding this concept is crucial since practically all the actions we will explain later, okay, everything I will explain later will depend on us understanding that for there to be a buyer, there has to be a seller on the other side, or the market will not move, okay? So the well-informed traders, these professional big traders, when they enter and exit, they are normally going against uninformed traders, retail traders. That's just a fact. And they know how to trade against them. So we want to learn how to trade with the institutions. And this is what we're going to discuss in the supply and demand module. This is going to take your trading to a new level. Now, this is key. We have to understand that we always hear for every buyer, there's a seller. But this is something that most people, most traders don't know, that there are different types of buyers and sellers. You have what is called the passive buyer, passive seller, and the aggressive buyer, the aggressive seller. Trust me, I'm not going to teach you anything that is irrelevant. This is all relevant, trust me. So for every buyer, there is a seller, but this understanding that they're passive buyers and aggressive buyers, passive sellers and aggressive sellers is very, very important. So now let's talk about what this means. So an aggressive buyer, okay, aggressive buyers are traders who buy from the offer. So we have some traders over here who said, look, when price hits $39.49, I want to sell 36 shares. When price hits $39.48, I want to sell 275 shares. These are passive buyers, okay? But the aggressive buyer is the one that says, look, I'm not waiting. I will buy at the next highest price, okay? The nearest price. So if price is somewhere in between these two numbers, the aggressive buyer will go up to $39.50 and pay that price for those offers there. That's what the aggressive buyer is. And on the flip side, the aggressive seller is not the seller who's waiting and saying, look, at $39.50, I'll sell $158. The aggressive seller is going down to the buy column, going to lower prices and saying, hey, look, I'll accept a lower price for what I have. So if the market is here at $39, $49.50 in the middle between these two numbers, that seller will say, look, I'm willing to go down to another price that's lower than this and accept this buy, okay? They'll accept the buy from whoever's buying. This 36 shares, they'll sell those 36 shares to that buyer. If they need to go lower to continue to sell more of their shares, they'll go to a lower price point and accept a lower price for those shares. That's what the aggressive seller is doing, okay? Now, we'll talk about how and why this is relevant in just a minute. The passive buyers are traders who buy, but they're working a bid into the market. These are those who place limit orders, okay? They're waiting for sellers to come. The seller, the passive seller, has an offer at a certain price and they don't want to sell lower than that price. They're waiting. They are waiting for a buyer to come, okay? So think about selling a home. We'll talk about why all of this is relevant in just a minute. But if you think about selling and buying a home, so there's a seller, let's say the seller wants to sell the home for $700,000. And there's some buyers who have bids for 650, 625, and 600K, right? Nothing's happening in the market right here. Nothing's going to happen because the offer and the buy doesn't match. Okay, the offer and the bids, they don't match. So if there's no trading here, so the market is not moving because there's no trading. There's no trading unless the seller is willing to lower their price to match a bid or a buyer raises their bid to match the offer. So let's say the seller is motivated to sell there's a number of reasons that they could be motivated. If they're motivated to sell for some reason, they need to hurry and leave. They need to hurry and move. They're starting a new career, starting a new job, etc. Something with family. They can lower that price to $650 to meet one of the buyer's bids. Okay. And then that's when the trade happens. That seller has to be willing to take that $50,000, okay, discount. They want to sell at $700, but nobody's buying. So they have to be willing to sell at $650. They're going to take a $50,000 discount, $50,000 hit. So the buyer got a deal, but the seller lost what could have been $50K if they would have found a buyer at $700. Okay. Now, the opposite can be the case, right? Someone can be motivated to buy for a reason that we don't know. So that buyer may raise their bid to $700K, pay that additional 50K between those two price points. We have no idea why, but this happens. So the point is there are different types of buyers and sellers, and everyone has their own reason for trading. And now we need to understand this because number one, we have no idea who amongst the big traders are going to sell and buy at certain points. We don't know. And then we don't know exactly why they're doing it at a certain point. There are many different reasons. We don't know why, but we need to be able to read the signs. So we're going to go to the charts now. This is all the theory, right? So again, I just want to reiterate about price movements. In order to move the price higher, buyers need to acquire all the sell orders, the supply that are available at the price level that they're at. So what that means is if a buyer comes in here and says, okay, at $39.50, I'm going to buy 50 shares. That means that there's still 108 available. So that's not enough buying power to push the market up. It goes up, but the buyers have to clear all of that in order for it to go higher. Okay, so that's what it means. So they have to acquire all the sell orders, supply that are available at the price level and continue to buy aggressively to force the price up one level and find new sellers. So here, what this means is that once they buy all of the supply here, if they want to buy more aggressively, then they'll go up to this price point and buy all of this. And part of the reason that this is such a game is that you have big institutions who are also competing for what's available, because as they drive the price higher, they're driving the price higher with the intent of eventually selling and making a profit. All right, so passive buyers. So let's talk about the passive buyers. So the passive buy orders slow down the bearish movement, but by themselves, they cannot drive the price up, okay? The only orders that have the ability to move the price are the market buy orders. The only orders that have the ability to move the price up are market execution, market buy orders, okay? Saying, hey, I want to buy, give me the next best price. So now let's look at this chart. If we look at this chart, look at these candles here. Massive buy candles here, massive candles driving the price up. Okay, this is SPX 500, driving the price up. Now, for the buyers to go from 38.70 up to 39.66, what do they have to do? They have to be willing to buy all of the orders at each of these price points, okay? They have to be willing to buy all of the orders at each of these price points. So if you think about it, just think about it. If we buy right here at this point, hoping that the market is going up, we have to have a strong conviction and strong signs, a strong edge to be convinced that we should place a buy here, hoping or analyzing that other buyers, not us, there's another big buyer who's going to continue to push this market up. We have to have strong reasoning to think so. So if price hits this resistance right here, you see the rejection here. If we buy right here at resistance, we have to have strong reason to do so, because it is only those strong buyers that can come and buy all of the supply that's here and push the market higher. So from point 1 to point 2, the aggressive buyers have to be there. And if we can identify when they're there, then we can buy. But if we can't identify when they're there, then we should not be buying. Same for the sell. Price is at 38.97. For when price came up here and did this massive bearish candle, they came up here, see this long wick, and sold hard. For price to come from point 1 to point 2, there has to be aggressive sellers that are saying, look, I'm going to sell and I'm going to continue to sell and take out all the bids. Whatever they are offering, I'm taking it. And they're going to continue to push the market down aggressively, finding more bids. So if we are selling here, we have to be convinced by patterns, by our technical edge, that there are going to be strong suppliers who are going to sell here, and that we will most likely be on the right side of the trade. That's what we have to be thinking about every single time we trade. We have to understand that it is not us moving the market. We have to see clear signs that the aggressive buyers or the aggressive sellers are in the market and they're going to push in one direction or the other. So sometimes you'll see consolidation happening at a particular zone and people will just start getting into the trade because it's at a particular zone. But that's not why we should get into the trade. We still have to see the sign of aggressive buyers or sellers at that zone in order for us to be convinced that price is going to go in the direction that we are desiring to go, or that we are anticipating it to go. So now there's something, let's go a little bit deeper here. And as I said, watch this video several times if you need to. This is a very important video. What else can move the market? Based on what we said, what we were saying is that the lack of interest and imbalance moves the market, okay? So listen to this. It is also critical to understand that the absence of one force can facilitate price movement. In the same way that a lack of supply can lead to a rise in price, a lack of demand can cause them to fall. So a withdrawal of supply will result in fewer contracts, okay, being placed in the ask column, allowing prices to rise with less buy power. A withdrawal of demand, on the other hand, would reduce the number of contracts that buyers are willing to submit in the bid column, resulting in a decrease in price without much effort from sellers. So what does that mean? So if price is here at 100, this is the price point. Let's say we have only small contracts here, 5, 7, 15, but we have large buy contracts on this side, okay? There's an imbalance between the two. The sell is small, so there's a lack of interest of selling here. There's a much stronger interest of buying here. And although I don't use this, the process of reading tape, but this is what, when you read the tape, this is what you're looking at. You're looking at these offers that are going in, you're looking at offers that went into the market. But that's besides the point. The point is here is that if price is weak, or the absence of sellers are in the market here, then the buyers can easily come and push the market up higher and higher with less power. So they can knock out 5, they can knock out 7 contracts, they can knock out 15, they can knock out 26, they can knock out 44. So sometimes when you see the market going up in what you may think is a weak market, like sometimes in the holidays, the market may be trending up, or just not trending up, but just moving upwards. It may be that there is such a lack of supply in the market, such a lack of like sell contracts, right? That it's whoever's buying in the market doesn't have to be a very strong presence of big buyers, because the contracts are so small. They can easily consume those contracts and push price up. So this is very important. So people call out imbalances. They say, oh, there's an imbalance in the chart. That means we're going in the opposite direction. Not necessarily. This is the cause of the imbalance. And for traders, for price to go and quote unquote fill the imbalance, there has to be an initiative by sellers. And when you look at indices like US 30, you can have a whole month, 2, 3 months, there's an imbalance that never got filled. Why? Because the concept of supply and demand is dynamic when it comes to the market. You don't have to go back down to products like in a store. If you think about gas prices, for example. So when I was a kid, gas prices was like $1 a gallon. Now gas prices are regularly like, maybe $4 a gallon, right? So price never went back down. It's similar here. Price does not have to go back down and fill an imbalance. Supply and demand can work itself out and land at a higher point where equilibrium is reached at a higher point, right? So again, let's look at the chart. So there's aggressive buying here. So look, there's more of a balance here of consolidation, okay? Selling, buying, selling, buying, selling. So there's a struggle here between the two. But you see this blast of aggressive buyers here pushing the market up. That is a sign of imbalance. That's a sign to say that there aren't any heavy sellers here. So the buyers can push the market up, okay? So imbalances come from aggressive buyers, but also the imbalance can come from the lack of interest, lack of sellers being there. Because if there's some heavy sellers there, then the market won't move. It'll just stay here like it is here, okay? All right, so same likewise, if there's an imbalance on the sell side, that's aggressive sellers saying, I'm going to sell into all the bids. I'm going to hit all those bids. I'm going to keep pushing the price down and keep selling aggressively at lower points. And there isn't enough demand. Nobody's interested in buying right here. Retail traders may be buying right here for some reason, but the big people buyers with the big buying power, they are not interested here. That's why the market continues to move. If they were interested, they could consume, which we'll talk about in just a minute. They could absorb the sell pressure and halt the market, but they aren't there. So what should we be doing? Should we be trying to buy right here? No, no way. Why? Why would we try to buy right here? We have no idea if the aggressive buyers are going to come in. Okay. We should be looking to sell. All right. So again, for the price to move down one level, sellers must consume the orders. Aggressive sellers must consume all 50 of these. And then if they want to continue to sell aggressively, they have to consume all 66. They have to consume 95, 130, 249, 120. They're hitting all of the buy orders as they go down in price. So if you see the market tanking down, you need to be figuring out how to get into the down movement. Why? Because there's a big seller that can consume all of the demand as it's going down. And you're going to be consumed as well if you're on the other side of it. Likewise, for the price to move up one level, buyers must consume the 75, the 90, the 120, the 500, the 550, right? So you see bigger orders coming in as price rises. This is what happens. You see that slowing down of price because there are bigger, larger supply contracts there at higher levels, because these big contracts, they want to sell them at a higher level to make a higher profit. Now let's talk about absorption. This is very powerful, very, very powerful concept. So traders, again, trading always involves a buyer and a seller on one side of the market, right? So one side there's a buyer, one side there's a seller, always. There's at least one buyer and one seller on each side all the time. One may be bigger than the other. One may have more buying power than the other though. So the absorption refers to the ability of one side to block the market in one direction through limit orders. They do these through limit orders. So for example, here you have the market trending upwards. And as the market is trending upwards, we see that the price is halted here. What's happening here and what we see in the chart most likely is that there are large sellers that are there consuming, absorbing the buys, okay? So as we just looked at on this chart, up here, there's 600, there's a 600 contract here, right, size, right? So as the buyers raise the market up, they may hit a big one. This is relatively big, so I kept these numbers relative, right? So 900, 980, 720. So the buyers come in here. If the limit order is too large for them to consume, let's say they get to 106 and they can only consume, the buyers can only consume 400. That market is going to stop right there. It's not going to move. It's going to stay right there until more buying power comes in. So when you see the market halt like this, that means that demand has slowed down, right? It could mean that demand has slowed down and there are big limit orders there and the price cannot push up. It doesn't mean that price is automatically going to fall, because in order for price to fall, you have to have aggressive sellers that are going to come in and push the price down. But if it goes up there and consolidates, then we should not be automatically selling. We should be hoping for the breakout. If it breaks that level with the large supply, most likely it's going to continue to go even higher. So I want you to understand this concept of absorption. So now we're going to get into the supply and demand zones, how to see where the suppliers are, how to see where the buyers are that have the big demand. Once you understand how to spot these supply and demand zones, once you practice these, once you put them into your A setups, once you insert them as A setups into your playbook, once you practice them and master them, you will become deadly in the market. You will pass your FTMO challenge, your MFF challenge, the funded trader. You'll pass those challenges because you'll be on the right side of the market, and you'll be patient enough as well not to be on the wrong side of the market, not to be trying to time the sell here. It just doesn't make sense. You have no idea when the aggressive sellers are going to come in until you see a pattern that shows you so. So I hope that this was beneficial. Leave your comments and questions in the comments section. See you next video.